they will still require substantial input from a bearish private sector, if you will. I think Layla will give the details and the numbers in her presentation. However, I just like to say that, that we have witnessed a decline in the investments outlook in the energy sector in 2020, owing to the what I described as the triple crisis, the magnitude of which is in the range of almost $20 billion from last year. We have also seen the share of the private sector in the energy investments coming down from 22% last year to 19% this year. And the capital costs in the energy sector were also cut by at least 20%, particularly in the oil and gas sector, leading to a wave of possible mergers and acquisitions, few examples of which we have already seen in the region. So we are looking at a sector that will be undergoing a tremendous stress and also changes. And we would like to share with you now how Apicorp has looked into this situation and what type of conclusions and recommendations we would like to share with the community out there. So thank you very much for listening to me. I will remain, of course, and look forward to the questions at the end, and give now the floor to my colleague, Dr. Layla bin Ali, the Chief Economist and Head of Strategy at Apicorp. Thank you very much. Layla, over to you.
Thank you very much, Dr. Ahmed. Welcome, everyone. We are very happy to provide you with this webinar on our investment outlook and how we see, as Dr. Ahmed mentioned, how we see the future of the world, because we thought for this webinar, instead of just providing you with the numbers and the stories and how the energy sector and investments are being affected, we also wanted to spend some time on some of the underlying assumptions of the story that is unfolding behind our eyes. So with your permission, I would like to spend some time, probably 10 minutes, on where we see the unfolding current crisis, or we like to call it now the global reset, because we see that the economy is resetting and the energy sector is resetting as well. And then during the second half of the presentation, during the second half of the presentation, I would like to focus on the energy investment outlook per se. These numbers, I'm sure you are now familiar with these metrics that you see in this slide. Some of us are even tracking them on a daily basis. The good news is that after the global cacophony that we've witnessed between February and April, the world reached a consensus on three interesting lessons. I think lesson number one, this is an easily transmittable and lethal virus that we are dealing with. We are approaching 9 million cases in the world. We are potentially exceeding 500,000 deaths in a world that is much more connected and much more interconnected and interdependent than before, and which depends also on China for its global value chains much more than before. Lesson number two, our macroeconomists now agree that this is a very different crisis that we are seeing today compared to 1929, 1973, or 2008. And this pandemic should definitely be modeled differently, because you will have potentially long-term unemployment in the most affected sectors. You will have bankruptcies, you have the reconfiguration, as I mentioned, or the reset of several sectors, and it's all happening at the same time. So we agree, when I say we, the macroeconomists in general, agree now that I think the lost outputs during this year and potentially parts of next year will not be recovered before 2023 at best. And the GDP growth rates in 2020 that you've seen being modeled by the World Bank, the IMF, and other global institutions will continue to be revised downwards as we gradually include and take into account the second round and third round effects of this crisis. And by second round and third round effects, I'm talking about lower capex, delayed FIDs, as I will present to you later in this presentation, layoffs, bankruptcies, supply chain disruptions, NPLs, precautionary savings, negative demand shocks, and of course, lower FDIs, foreign direct investment. There is, which I think is a very important lesson for the energy sector, there is now a clear awareness that we've seen today, I think, the most extreme demand response that you can get. We have locked down nearly half of the world's population for a few weeks. We have drastically reduced transportation and industrial fuel consumption. And it seems like that is not enough. It is not enough. If you look at the first few months of 2020, global daily emissions averaged 18 to 20% lower year on year. That's an unprecedented decrease, but it is not enough to reach the Paris Agreement targets. If I remind you, this was to limit the greenhouse gas emissions to levels that would prevent global temperatures to increase more than 2 degrees Celsius or 1.5 degrees Celsius for the most ambitious above pre-industrial revolution. So these are, I think, three main lessons that we learned from the current crisis. And if you look at the report, we have articulated three main episodes in this crisis. And APICOR being based geographically between East and West, I think we could watch the unfolding episodes as they were transmitted from Asia to the rest of the world. So as Dr. Atiga mentioned, we started with the health crisis. As you know, governments have faced that unbearable dilemma to choose between saving the economies and saving lives. There has been an incomplete consensus in the beginning. And today we are reaching a stage where we're still having all coordinated, flexible, reversible policies as governments try to open up their economies. Our assumption when it comes to the resumption of travel and trade, because that has a direct impact on energy demand, is that you will see some coordination bilaterally and or between groups of countries. Particularly, we need to see how the summer season will evolve. Second episode, the oil glut. I think we have all watched it very carefully. Oil demand witnessed its largest decline ever. Minus 8 million barrels a day of demand decrease in 2020 on average, estimated, is the largest decline ever. And that, of course, has created a major supply glut, record inventories. But beyond, I would say, the short-term trading gains that the recent volatility, including actually in the oil price future structures, when we see oil price futures switching from contango to backwardation overnight, I think at APICOR we are watching more carefully the longer term ramifications of the current oil glut. So in addition to what I like to call the elastic shut-ins, primarily in the US, because as you all know, US production dropped to the lowest level in 2 or 3 years, below 10.5 million barrels a day. When you see large independents, large companies like Chesapeake filing for Chapter 11, when you see high-cost assets being written off, not only the traditional high-cost deep offshore operations, but also some developments in Russia or Nigeria, I think it is clear for us that the energy sector will emerge post-2022, will be in a totally different shape than it is today. Episode number 3, I think you've all followed the unprecedented stimulus that governments and central banks have deployed, unprecedented conventional and unconventional stimulus package. I think when we reach $2 trillion, it will be an unprecedented stimulus package. There are different mechanisms, of course, to ensure that this will translate into the real economy. Different mechanisms. We just want to ensure that we are adding up, hopefully, productive debt into the equation. Here in the GCC, you can see that sovereigns were able to raise in less than a month, in the month of April, more than $25 billion of 4 to 6 times oversubscribed bond. These are countries with very good ratings, but how about the rest of the emerging markets world? That's making up more than 40% of the global GDP today. And there we are watching a very serious credit health question, even in large, I would say, emerging markets. If you take, for example, one metric, the ratio of external debt to foreign exchange reserves, South Africa is already above 300%. Mexico is close to 240%. And if you look at the smaller frontier markets, and Lebanon is one example in our region, they increased their debt burden dramatically, more than 3 times over the last decade because of investor demand for higher returns. And the debt of the frontier markets have increased to around $3 trillion. That's more than 100% of their GDP. So today we are in a situation where emerging markets as a whole are owing more than $70 trillion. Of course, you have some countries that are better equipped than others, China being one of them with its huge balance sheet, but we're still concerned about some of the other emerging markets, particularly the ones that are highly connected with the MENA region. I need to give you some positive stories as well. And that positive story is included, I think, in some of the hypes that you could see in the markets, particularly in stock markets. You've all noticed the increases in S&P 500 at the end of May, and NASDAQ plus 1.3% in the last week of May as well, the highest in 14 weeks. MSCI increased as well in the last week of May. So there were a few bullish factors that were taken into account, and some return potential hope of increasing consumption, particularly with governments opening up their economies, a return to some better employment jobs and job creation in countries like the US that is tracking job creation better than other countries. We also see the potential for pent-up demand and entertainment. And here you have one graphic just showing you that the Germans were desperate to book seated dinners as quickly as possible when Germany started to open in May. And there will be potentially some change in consumer behavior and lifestyle, where people might prefer actually to drive again in personal mobility instead of public transportation. That might have an impact on energy demand. It's very early to see how the long-term ramification on energy demand these changes will make. But for example, if we assume that there could be a potential shift to home working in some countries and some regions, that would result in a decrease in demand for office space, of course, and energy for commercial buildings, but at the same time, that could be offset with people living further from the workplace. And of course, some positive numbers that were coming out from China as we go. So I was talking about the bullish side. On the bearish side, and I hope you see the graphics much better, but they're giving you the story that you already know. People are concerned about the second round and third round effects. They are concerned about lower capex, delayed FIDs. There are fears of the second waves, fears of the third waves. But more importantly, I think that there is less fear of increasing infection rates than a fear of reversible lockdown policies. So that's why you can see increasingly precautionary savings within consumers. As I mentioned early on, very briefly, and in the report as well, we are watching also very carefully increasing tensions and protectionism as countries are reverting to more sovereign policies. And one example is, of course, the US-China trade war that was already unfolding before the crisis, but got accelerated after January. Hong Kong stocks, more specifically, reached their 1998 lows at the end of May, on May 29. So I just wanted to move quickly into the implications on emerging markets, but more particularly on commodity-dependent emerging markets that that are being affected by what we call the triple whammy, but also by the transformation of our triple whammy. The crisis, I think, has exposed three key economic vulnerabilities. And in the graphic that you see here, you can see the cycle that is relevant to most commodity-dependent countries. You start with low commodity prices. It hits the non-commodity sectors. It translates into falling reserves, and we're providing you here with an example of Iraq. And it translates into a high borrowing costs for the countries, and then into ad hoc anti-cyclical measures. So first, I've already mentioned the credit health issue, because the risks of default increases at the sovereign level, but also at the corporate level. Significant stress on fiscal budgets, and I will explain to you how some countries have are dealing with the significant stress. And third, the countries that are exposed to the decline in global demand for goods and services, because this has effects, of course, the commodity sectors, also the non-commodity sectors, the exports, tourism, remittances, etc. So we have already started actually a phase of very fragile economic recovery. That's why in the report we talk about W-shaped recovery, particularly for those countries which are highly affected by volatility in commodity prices, are non-investment grades, and are having high fiscal break-even prices. They will have to face also continued fiscal adjustments with some additional anti-cyclical budget measures. So I'm giving you the examples of some countries in the MENA region. Saudi Arabia has already cut its 2020 budget by 5%, has tripled VAT. Bahrain has cut public expenditures by 30%. Oman has reduced its budget by at least 15%. So in several MENA countries, financing the deficits remains feasible, but there will be increasing pressures on liquidity and exchange rates. So expect additional reforms on labor markets, on subsidies, because stability can be bought here, but at a cost. If I take the example of Saudi Arabia, public debt has increased to more than 30% of GDP. That's the highest since 2005. The foreign exchange reserves dropped to by nearly $50 billion, but that's still 3 years of import covers. The US dollar pegged should be maintained for now, but we are, in most of the region, we are looking to large fiscal deficit pressure. And I still want to insist on some pockets of instability, of vulnerability. Lebanon now has been described by the Financial Times as in a state of full blowdown depression, with an estimated 48% of people living already below the poverty line. So let's move in a couple of slides to oil and gas markets. There will be downward revisions to economic and energy demand outlook, as I mentioned, as I explained. We expect governments to unlocking plans to continue to be flexible and reversible as much as possible by keeping the economic pain to the minimum if possible. So therefore, the energy industry will have to adapt to a potentially long downturn period with periods of volatility. So, and this is also confirmed. I was looking at gold prices this morning. Gold spot prices are increasing thanks to safe haven demand. Gold spot prices today are breaking the $1,780 per ounce. That's the highest level since 2010. And that has also been spurred by the euro-dollar parity as well. That is in that high band of 1.12, 1.13 for the last couple of weeks. So this explains, and that's one of the reasons, that's one of the questions that we received as part of the Q&A even before starting this webinar. It explains basically our slightly lower than consensus oil price assumption of $30 to $40 per barrel for Brent. And that's an average. It is not a band. It's an average that we are seeing because we expect bursts of volatility outside of this band. This is my favorite slide showing you the emerging major sector implications in the two major industries that we operate in the energy sector and the banking sector, and that will explain to you how we view the rest of the outlook in terms of funding and also in terms of investments in the energy sector. So there are, because if you have joined us in our past events and our past webinar, I think you are already familiar with some of the assumptions that we are taking into account here. The first key assumption is that the energy sector and some of the related sectors, infrastructure, energy intensive industries, mining as well, have provided some of the lowest returns to shareholders during the last decade, and by a wide margin. We already know that. So that's assumption number one. And the producers that are in the best fiscal position will race to preserve their long-term value proposition, sorry, to shareholders. And they will continue to alternate market management and volume maximization. But the companies, major energy companies, will be compelled to adhere to their dividend policies as much as possible and as long as possible to preserve, again, their value proposition to their respective investors, be it governments or private shareholders. And this comes at a time, again, where share prices have decreased, have fell 20 to 30% across the board year to date. So that's the reason why we see, in addition to our capital costs cuts of 20%, particularly being hit in the oil and gas sector, we see planned spending being cut across the board in most of the sectors in the energy. Second assumption is that flexibility in the new, I would say, post-COVID world, flexibility, scale, and mobilization of significant financial resources to finance working capital and other needs and to manage this price risks and volatility will be vital for energy players. And the third assumption, and I hinted at it at the beginning of this presentation, sustainability is not the only factor that is driving the energy industry's transformation. Regulatory risks now matter in this post-COVID world because there will be consequences on investments returns. If you agree with me that cash-strapped governments will look at ways to get some additional money and fill up their coffers again, you will have companies in sectors with regulated returns. We are watching utility space, more specifically, midstream space, more specifically, and low tax, that's part of upstream. They really have to navigate that regulatory risk. So expect also maybe some fiscal terms to be renegotiated over the next 5 to 10 years, particularly if we assume that cost of capital might be increasing for specific sectors of the energy industry. Let's not forget that when it comes to efficiency gains, another point, which is that the energy industry players globally and in the region reached 2020 much leaner and relatively cost efficient after the two recent downturns that we have witnessed, the 2008 financial crisis, and the 2014 oil price crisis. There is so very limited room to maneuver in terms of short-term budget cuts. The push for additional efficiency additional efficiency gains that we are assuming here of 10 to 30% potentially particularly in oil and gas and oilfield services, will come with a price. Will come with the price of additional closures, bankruptcies, and higher decommissioning costs in specific parts of the value chain. That's opening the door, of course, for waves of additional integration, particularly in downstream. We've already seen in the region the wave for large integrated upstream to downstream and petrochemicals integration, that we see that continuing to get the most out of your molecules, and also additional integration in electricity. So additional asset sales and merger and acquisitions over the next few years. But that will also come up at a price, because all the, I would say, investors are looking for lower valuations and distressed entities that are not in a fragile structural shape. Some of the interesting things are happening also on the midstream side and pipeline investments. Pipeline divestments, I think you've seen and that will have an impact on the role of the private sector in the next few years in the energy sector. You've seen the $5 billion oil pipeline KKR deal last year in Abu Dhabi, the continuation of that $20 billion for the gas pipelines in the UAE, led by several investors. We can see some of that in other countries because there are other candidates with, again, good assets, well-maintained, long kilometers of oil and gas pipelines that could be leased at least or divested at some point. There is an emerging trend, of course, with the acceleration of this digitalization and decentralized, decarbonized electricity generation. I would like to move quickly to the banking sector. So the banking sector, as we see today, arrived in 2020 with a better shape than it was in 2008. Higher capital ratios today of 7 to 8%, of around 14% compared to the single digit in 2008. It is expected to mitigate the impact of the current crisis, including in the energy sector. However, the energy sector has been one of the most affected sectors in this crisis. So you expect banks with the highest exposures to airlines, to transportation, to cash-based SMEs also that took a lot of hit of this crisis to face significant difficulties. So even in the banking sector, particularly in the region, we see also, and we have already seen an example this week with NCB and Samba deal of consolidations, additional consolidations in the banking sector and increasing competition in the banking sector to provide funding for the energy sector. Without further ado, because I think I took the time needed to explain the view of the market as we see it, I would like to move to where we see the investments over the next 5 years. Now, I think you are accustomed to how our methodology in estimating future energy investments outlooks in the MENA region. And International Energy Agency provides the global outlook as far as we are concerned, and we are a peer reviewer of the International Energy Agency's global outlook. So we saw some of the major trends in their outlook before it was issued, and there are some major differences between what is happening globally and the MENA region particularly. For the sake of transparency, we wanted to show you where we saw MENA energy investments before the crisis. So at the beginning of this year, we were just running the numbers and before the break of the crisis. So from that perspective, there are two things to compare. First, where we stand, and this is what we put in our outlook report, the $173 billion reduction compared to last year's 5-year outlook across the board. That's something that is quite similar to the major trends that we are seeing globally. But we are still having a large number that is roughly $800 billion of investments expected over the next 5 years. And that is being driven by some of the structural countries that are driving this investment. So if you take Saudi Arabia's gas and power program, that's roughly $40 billion each. If you take Iraq's reconstruction efforts and the gas to power schemes that are totaling more than $30 billion, there are some uncertainties there that we are taking into account, but these are still projects that we are expecting to continue to be planned at least. Iran's gas projects, they had a large gas program that we have downsized a little bit, but some of it will have to continue because of, again, domestic market reasons. UAE oil capacity maximization that was already in the card, estimated at more than $40 billion. Egypt's petrochemicals drive that is quite strategic for the country, that's nearly $40 billion. And the power sector modernization program that was long overdue, again, more than $35 billion. So because of those, I would say, large pockets of strategic and important programs, our investment outlook stands where it is today, where we see decrease, but it could have been much lower than an interesting story that is unfolding in the MENA region compared to the rest of the world is as far as gas is concerned. And in the gas sector, we see that it has registered the highest increase in planned investment, 13%, as you can see on this graphic, or roughly $28 billion. That is signaling the continuation and the confirmation of the developing of unconventional gas. I mean, you have the example of Jafurah in Saudi Arabia, Hail and Gasha, and also increasing productive capacity in Qatar that is continuing and confirming its gas development program, and other countries like Egypt and Oman. So you have strategic marketing reasons and domestic market reasons as far as gas is concerned. We still see some risks. I showed to you a bit early on our gas pricing outlook, where we see continuation of depressed gas prices, particularly in the LNG sector, that will affect some of the, I would say, high cost gas developments in the region that are targeted for exports. But again, we still need to see how the domestic reforms on the gas side will unfold, particularly if you see a lower demand on the industrial front. That's something that we are also watching very carefully. So the story, as far as gas is concerned, is still positive, but moving a lot. As far as petrochemicals are concerned, for now, as you can see in our report, we have not included major changes in the petrochemical strategy in most of the countries, because we expect countries to continue to consolidate their chemical strategy. We have highlighted some issues, some uncertainties in specific projects in Iraq, in Egypt, in Iran as well, because of the sanctions. But here again, overall, we see a continuation of the large petrochemicals, particularly the integrated petrochemical projects that were already pushed for, again, different economic diversification reasons. Utilities, that's the other major difference with the rest of the world for now. Again, we don't see any major credit issues as far as the utility sector is concerned. We've seen some fragile utilities in the regions that were struggling especially over the 2 months of extreme lockdowns, to get their bills being paid by the distribution companies. But overall, the renewables programs have been ongoing, nearly not delayed. The rest of the investment plans have been ongoing as expected. But here again, we are watching very carefully, because there are some pockets of uncertainties in the utility sector as well. And again, in my next slide, I will show you the share of the private sector, and how the private sector that has been driving also investments, especially in countries like Morocco and Jordan, in the utility sector, will continue to play a major role. We've seen a small dip of 19% compared to 22% as the private sector share of total investments this year compared to last year. But again, it depends on how we see, and when I have this discussion with Dr. Ahmed Atiga, it depends on whether we see the glass half full or half empty. But there are some interesting trends happening as far as the private sector is concerned. If we assume that the utility sector that has been driving the private sector investments in the next few years will be more dependent on decentralized utilities, we are going towards more distributed generation, and we are seeing potentially more divestments and leasing schemes in midstream and pipelines. We might see an increase of private sector shares in the rest of the sectors as well. But we are also watching in this private sector, mainly in the oil field services. We have some national champions that are being affected by the current crisis, especially that they came, as I mentioned, weakened by 2 consecutive downturns. They are facing now increasingly squeezed cash flows, and you could expect some restructuring in that part of the sector. Again, you have the details of these highlights and graphics in the book, in the investment outlook. A few things to mention here. In terms of the committed investments, you can see that the large The lion's share is concentrated in 3 countries, Iraq, Saudi Arabia, and the UAE. These are projects that are already under execution, so the risk of it being revised downward is relatively low. But when it comes to planned investments, you can see that the concentration of the projects under study or EPC or FEED are concentrated in Saudi Arabia, the UAE, and Egypt, exceeding $60 billion for each country. So this will give us a view on where we stand in terms of planned investments in those on a country basis. I'll give you here just the top 10 MENA projects, and again, I'll open it as an invitation for everyone. If you have a specific insights or specific feedback that you want to share with us on specific projects in your respective countries, or something that you are following personally, feel free to contact us after this webinar, and we'll be happy to share insights with you on the specific projects that we're having. But the key message from this slide is that the mega projects that we were seeing in the region, the plus $5 billion that we were seeing in the region, are still there and are being confirmed because, as I mentioned earlier, a lot of them are either covering domestic demand or are being pursued for strategic marketing reasons. And I will finish this presentation with some of the mega trends that are increasingly interconnected, I'm afraid. I've already mentioned some of the trends that we are watching on the financial side and the monetary fronts, on the macroeconomics and the trade as well. And I would like to highlight here the third pillar that we are watching carefully, because it has a direct impact, again, on consumer behavior and energy demand. If we see an increase in penetration of technology and a change in consumer behavior and an increase in digitalization, I think we can see an emerging energy sector in the next 3 to 5 years that is totally different from where it is today. Thank you very much, and I would like to open the floor for questions and answers. So I'm looking at some of the questions that we have received. I think some of the questions have already been answered in the presentation. For example, how do we anticipate the reaction of the energy sector to sustain the industry over the next 2 years? I think we've provided, if you look at the slides that we have shared with you on the emerging market trends in the energy sector. But again, I would like to insist on the fact that we need to look at these things in a very interconnected way. The energy sector cannot do it alone. It will have to have access to financial resources on a massive scale to be able to finance working capital and go through the crisis. So I think it's important to look at how the two sectors are evolving in parallel. And Dr. Ahmed, feel free, as you can see the questions as well yourself, feel free if you want to answer some of the questions that are potentially related to Apicorp. Well, there is an interesting question to me. Given the high uncertainty surrounding the demand for oil currently, do we expect a lag in response from the major regional producers? Should the demand see a sudden increase to levels closer to pre-COVID-19 level? In other words, could demand uncertainty lead to supply shocks as well? Absolutely, absolutely. And this is the reason why ourselves and organizations like the International Energy Agency, that's the main reason why we're tracking energy investments. Because if you see, one thing that I forgot to mention in the presentation is the downturn, the reduction in capex that we've seen today is very different from previous downturns on two aspects. First, the reduction in capex started immediately in 2020, while in the past, you've seen a lag of few months or 1 year before this reduction in capex took place. Today, we are seeing it as immediately as 2020. And the other problem is that the reductions of more than 30% of capex across the board, in oil and gas, in utilities, etc., is also quite high compared to what we had in previous downturns. So in the next, the other issue that we are seeing is the length of this capex. So if demand comes back, and demand will come back, now there are a lot of debate among energy economists on whether we will see again 100 or 110 million barrels a day of oil demand in the next few years. I think regardless of the level of demand that we will see, you will get an increasing amount of volatility because it will be very, very difficult to bring those investments back on track. The length of the capex cuts is higher. 2 or 3 years is much high, is a major. 2 or 3 years with 25%, 30% reduction year on year is massive. I think the change in role of IOCs and NOCs and the role of pension funds, activist shareholders, taking the cherries as presents, new Seven Sisters in the making international. I think that's at the core of the massive transformation that we have detailed in a couple of papers that we've issued late last year and earlier this year. So I think this was a trend that we were seeing before this crisis, that again, large energy integrated companies with access, privileged access to shareholders' funding, will have an impact on the nature of the winners that will emerge in the next few years. And it's true that you might see consolidation and the restructuring of the energy value chain to, again, large energy integrated players. Now, the only part where I might be a bit skeptical is the international drive of some of the national oil companies, more particularly, and including some of the international oil companies. Because one of the lessons of this crisis is that it is good to be integrated, but it's also important to manage your supply chains very carefully. And I don't think that the world can replace China or Asian shipyards when it comes to the LNG sector, or technology centers in Italy or in the US that easily. The energy sector will still be dependent on a globalized value chain that will ensure that this sector continues to operate. However, there will be, I think, a pressure to localize the value chains as much as possible and mainly closer to the consumers. And that, I think, a trend that will also happen in the energy sector. So the international drive might be driven by the need to diversify and diversify away from the domestic markets. But there will be, I think, there will be some pressures to continue to continue to consolidate your supply chains and value chain.
Let me, Leila, take a couple of questions, please.
Please.
Just to give you some time to take a breath. Thank you very much for the questions. I think, as Leila said, most of them, some of them have been answered in the report. But let me focus on a few of them that are directed towards financing and maybe the role of APICO in this regard. There was a question on, well, first, I think the overarching element of financing during a crisis from institutions like APICORP and other multilateral institutions, be it in the region or globally, is to play a counter-cyclical role, is to come in when other financial institutions are walking away. This is a role that institutions like us have to play. And in this regard, we announced a 500 million package for counter-cyclical support to private sector and public sector energy and petroleum projects that will need additional funding in order to have it implemented, be it working capital support or liquidity support. And this particular role has to also be played in partnership, where others have to come. And having the multilaterals in the lead gives comfort to other financial institutions, banks, and so on, to also take part. So you will see much more of that role being played in the next few months particularly to support key projects that otherwise could be affected. Both equity and project finance, but I think more so on project finance. On equity, definitely the opportunities for having attractive assets to invest in and to be patient with. There was a question here about the role of patient capital. Yes, multilaterals and other similar institutions can be patient because they come in order to play a role, and as long as that role is not satisfied, they will stay in the investment. And I think this particular circumstances that we live in will both present attractive assets in all related sectors, and there are already some examples, and at the same time allow for the capital to be patient, as was put here, in order for the implementation to take course during a reasonable amount of time. There was a question also on whether the GCC countries will remain or will focus on being green in their investments in the energy sector. Well, I think some of the GCC countries have gone a long way in that regard, the UAE in particular and Saudi Arabia. And it's only the more reason for these countries and others in the GCC to intensify their focus on doing green, as was mentioned here, be it in renewables or in clean and low carbon, low cost investments and projects in the petroleum and gas sector. So I think you will see, and I think that our report has shown that you will see more of that drive, both by necessity and also by strategic choices that these countries have started to demonstrate. There was a question on Saudi Arabia and whether the PPP and the privatization will continue. Well, that's what the PPP is all about. Is really, it's a tool that helps countries when the fiscal space really shrinks and shut down. And this is where we are, be it Saudi Arabia or other countries. So yes, the PPP projects in all sectors, but mainly in capital intensive sectors where the government budget can no longer support, I think you will see much more of a PPP schemes being used. And in that sense, I think the energy sector in particular is a prime candidate for these type of financing schemes. That's all I have maybe now, but Leila, go back to you for a couple of more questions maybe before we wrap up.
Thank you, Dr. Ahmed. Yes, actually there were a lot of very interesting questions, and we'll try to answer those after this webinar, and feel free to reach out to us to continue the discussion as we go. I think there were a couple of interesting questions around the energy transition and how IOCs and NOCs are going to behave in the new world, and also the fuel mix in the future post-COVID world. I think one of the interesting trends that is happening today, and we are seeing it unfolding, and that has an impact on major strategies and also on some national oil company strategies, that we are at a point where oil is transforming, is becoming a normal commodity. I hate to say it, but oil and gas is becoming like iron, like nickel, like copper. You will have low-cost producers and low-carbon producers dominating in the market share in the future, and the higher-cost producers filling in the tail end of the supply cost curve. This has been coming for some time, I think, and the COVID-19 crisis, or the global reset that we are seeing today, is accelerating this trend. I personally don't think that the market will decline in terms of overall energy demand over the next few years that much. But demands will be flat, particularly for oil and gas. As I mentioned earlier, there is that tension as far as the gas sector between utilities and the industrial sector. So it is, I think, to answer the question around the potential consolidations within the oil majors and the national oil companies, or whether they would want to become utility players. I think there is a push, and companies like Total and Shell have already announced that they want to have, want to go electrified and have a 40%, 50% of their portfolio in electricity and utilities. So that's a trend that is already embedded in some company strategies. But as I mentioned, I mean, this is a different sector to look at when it comes to one relationship with the consumers, especially if you assume that the electricity sector is becoming more digitalized and more localized and distributed. And second, the cost of capital and the rate of returns that are expected in these parts of the sector. So oil and gas companies in general, and that's a very generic statement that I will make here, who having been used to double-digit returns on investments in the past, will have to get into a more competitive space where even when the rates of returns are much lower, but also where the cost of capital might be lower as well. So these trends will be unfolding, I think, behind our eyes over the next few years. And when it comes to the fuel mix of the future, I think if you look at the space of technology and fuel space, we agree that there will be a place for every fuel and every technology, especially the low cost, low carbon ones. So if coal might be one of the areas that we would not want to invest ourselves as far as we are concerned, but all the other technologies and fuels will be needed in the future. And more particularly, we are watching the space of hydrogen and how it unfolds and how it helps, particularly, I would say, gas exporting countries and countries in the region that are having access to low-cost renewable projects, so are able to produce hydrogen at low cost, might transform themselves in the next few years. And of course, the usual suspects like CCUS and energy storage that we are watching also very carefully. So I think you will have, I would say, a patchwork of technologies and fuels that will be needed to cover the energy mix of the future, whether you believe in 100 million barrels a day oil market or not. I think we reached the end of the hour.
Yes, thank you very much, Leila. Thank you, Dr. Ahmed, and thank you for all the attendees who joined us. We are very grateful to you, and we hope you found it interesting. The questions were definitely very insightful, and we'll be sending responses to you as well. And we welcome any questions that you have additionally, and we'll answer them right away. I'd like to.
So Dina, we will prepare answers to many of these questions and send them by email, and also we will probably even post them on our website. I can see we have many questions that were not answered, but I think in the space of time allocated, it's difficult. However, as Dina mentioned, we will make sure to come back with answers. And at the same time, I really welcome this interaction with all of you. I have recognized many names of many friends and colleagues in the audience. And we really thank you for this opportunity with us. The report will also be available both in Arabic and in English. And as I said, it is an annual product of Apicorp that we will always benefit from your input on. Thank you so very much. Thank you.
Thank you.
Thank you. Have a safe and productive week. Thank you.
Thank you.